Welcome to the Clarity Curve, a podcast from Emergent Partners, where we cut through the chatter and get to what really matters in business. Each month, we dive into the challenges and opportunities shaping today's business landscape, from shifting markets and emerging technology to leadership, financial clarity, and operational excellence. Because in every business conversation, there's noise, and then there's what actually drives performance. I'm Maurice, managing partner at Emergent Partners, and together with industry leaders, clients, and colleagues, we'll explore how clarity, data, and strategy help small and mid-sized businesses turn uncertainty into advantage. If you're a business owner, executive, or decision maker looking for grounded insight, not hype, this is your frequency. Join us for the Clarity Curve, where we help you tune in to what really moves business forward. Steve, welcome to the Clarity Curve. Good to see you as always. You've been a big part of what we've been doing at Emergent Partners for quite some time.
Yes, I was one of your first employees.
Yes, you're one of the first employees. Tell the audience a little bit about you and what your background is and type of work that you've done.
Well, sure. I've been in the working field for almost 40 years. I've got a degree in MIS from A&M and UOH. I went for my MBA with a concentration in finance. Later in my career, I got a CPA license in Texas. So I've kind of got the finance, the accounting, and the technical background. Over the years, I've probably worked with about 30 different customers and clients, both as a full-time employee and for the last dozen or 15 years as a consultant, which gives me a lot of opportunities to use that experience to apply what I've learned from one client to another and really expand what I do. So the clients that I've worked with have had a lot of different challenges. It's given me a pretty good breadth of knowledge to know what's out there in the business world today.
Yeah, we have seen a lot of unique and interesting situations
for sure,
over the course of the last few years.
Yeah.
So most of the work that you've done for us is primarily a CFO level, advisory level work, helping clients review financial statements and structure financial statements and understand what's behind the numbers in those financial statements.
Yeah, a lot of times they either don't know what they're looking for or looking at, or have never really gotten reports. That's a lot of the challenge that we've seen in a lot of these smaller companies is they really don't get any reports. And if they do, they're not very good. The people producing them really don't know what they're doing, and the owners really don't know what they're looking at. So they really need a lot of guidance. A lot of times they think if I've got money in the bank, I'm doing okay. And running a business and looking at your financials is so much more than just a cash balance, obviously.
Yeah, it is. You know that they're living in this world for so long that there are different types of financial statements. So there are different types of reports that you get out of the company. I mean, there are the reports that you send to the IRS for taxes. Then there are the reports that you use to send to external third parties such as banks and other people that are trying to evaluate the financial health of the company.
Right.
And then there are reports that you use internally just to run your company. Right. And you have a lot of leeway in the reports that you use to run internally. You've got less leeway in some of the others. But I think that's one of the things that we run into is that business owners just don't understand that, hey, there are different types of reports out there that you need to use, and they're all important, and you need to learn how to generate all different types of them.
Yeah. You need to know what you need to know, kind of thing.
Yeah.
It's like I've got too much. I don't have enough. Tell me what I need to run my business effectively. That's really where they need a lot of help. And then from there, you interpret what the numbers are.
Yeah, exactly. We always talk about just general industry standard KPIs that the company should be looking at. But really, companies have the opportunity to determine what KPIs are best and most important to them.
Yeah, it can vary from industry to industry. That's another thing that companies should be aware of. What are other businesses in their arena doing? What are some milestones that are good for them to achieve? They just can't say that, their profit margin is X, not knowing if that's good or not for their industry. So there are some benchmarks that need to be aware of because every industry is going to be different. And you want to make sure that you're at least hitting those benchmarks for your category.
Yeah, absolutely. Gross profit margins are one of the things that companies really, really have a difficulty putting together, to be perfectly honest with you. I mean, determining, okay, well, revenue's easy. It's easy to figure out what's coming in. But you may have different types of revenue, so you need to make sure that things are structured so that you're breaking out those different types of revenue, because you may have two different services in your business and they have two totally different revenue and cost structures.
Yeah, for sure.
You need to track that accordingly. But I think really the biggest thing that, and I know you see this too, and I see it all the time, is really determining what that direct cost is.
Yeah.
So what's your direct cost of doing business on a per transaction basis?
Right. Yeah, you need to know if you're making money on a particular project or product line or whatever it is. And as you noted, that can be separate, almost a separate set of financials within the larger set, which can be a bit of a challenge. When you have a various product line, so to speak, you can't really look at everything in the conglomerate because things are going to get convoluted and you really won't have a clear picture of your profitability on a micro level, which is really what you need.
Yeah, absolutely. Well, and when you have different types of transactions, you manage them in different ways. And so when you're really looking at your KPIs, you really want to understand how those allow you to track how those transactions are going.
Right, right. Yeah, they're all going to be a little bit different. So there's no cookie cutter for all of them, just as there is no certain benchmark for all of them. They're all individual children that have to be treated differently.
Yeah, that's exactly right.
And you can't have a favorite.
Yeah, you kind of have a favorite. Yeah, the one that maybe makes you the most money,
Yeah.
generates the majority of the revenue. Yeah, but you can't forget the others.
Yeah.
But I'll tell you, I mean, I've seen and we've seen on projects that we've worked on together where, companies were looking at certain revenue streams and they were saying, well, I don't know if this revenue stream is worth it. And we sat down and looked at it and said, well, let's really look at what your margin is. And we looked at the margins and we did some evaluation just to make sure that we were getting pretty good margins with that. Upon looking at it, I was like, well, no, actually, your margins on this are really good. Your margins on this are really good. It's good, repetitive revenue.
Yep.
It's easy to sell. So you need to go out and sell more of this business as opposed to pulling back on this. Things like that can be really, really eye-opening because, I mean, let's face it, business owners, and we have a pretty good idea of what our business is doing. We have that intuition
Sure.
To know what's going on. But sometimes that intuition, it can be partially right, but it may not be all the way right. And there may be some nuances that we really need to understand.
Yeah, you can't pick up everything by osmosis. But to your point, I mean, if you're analyzing profitability and you say, hey, we're really doing pretty well on this and not so much on another, you need to reallocate your resources to get your biggest bang for your buck. And without analysis, you won't know that. And once you see that, well, I'm making a better profit margin on X instead of Y. Let me focus a bit more on that, like you said.
Yeah, absolutely. Because there are a lot of companies that will grow themselves out of business because they focus on growing a product or service line that is not necessarily as profitable as others. And so the overall profitability goes down. It's hard for them to figure out why, because you don't really have that broken out. And that really all boils down to chart of accounts. I mean, how many times do we see it? Generic QuickBooks chart of accounts or generic ERP chart of accounts. And it's tweaked a little bit, but it's just not set up for your business.
No, I mean, pretty much any company I've worked with, you're going to have to modify the chart of accounts. There's a basic categories by the first digit, essentially. But after that, if there's something you need to add or subtract, that's what you need to do because every business is unique and your chart of accounts needs to reflect that.
Yeah, exactly. And if you structure it properly, especially with your gross margins, then it'll flow very well through the financials. And in some cases, you can almost get real-time data as you get real-time data as you are invoicing and you get real-time data as you're paying expenses or at least accruing expenses, or at least as you're recognizing revenue and you're recognizing that direct expense.
Yeah, that's really the first thing you want to look at. I mean, your overhead and G&A and all that, you can work with that. And those can be a little bit easier in some respects to manage, but you've got to know what you're working with. And that's going to start at your gross margin. And then you look at the other expenses after that, but you've got to be in tune to what you're making, at the top before you to really get the full picture of it and adjust what you need on overhead and those sorts of things.
Yeah, I would agree. And, we've always said that your overhead expenses are expenses that you manage as a whole. You don't manage your building rent based on a per project basis.
Right.
And so you shouldn't allocate building rent to direct costs. The direct costs are the ones that you manage on a per project basis. We see a lot of people that say, well, I want what I call a true cost. And I want to allocate some of my overhead or my SG&A to my direct margin. Like, well, but you're not going to manage that on a per transaction.
Yeah, it's kind of interesting to know what that really means. And there is some indication of profitability with that, but it doesn't really affect you as much as direct costs that we talked about. I mean, you've got to have a building to produce a widget, right? But, is one less widget going to change your rent? Of course not. Or a lot of overhead that's fixed. And so allocating it to your production, I kind of see it, but it really doesn't have a whole lot of value.
Yeah, it really doesn't. And if you're in a situation and your rent is too much, then you can look at your individual transactions. You can look at your revenue versus direct costs, your gross margins, and maybe I need to raise my gross margins. Maybe my business is growing, but I'm not covering my overhead. So maybe my margins aren't big enough. Let me take a look at how competitive my pricing is in the market and also my standing in the market. I mean, if I'm not trying to be the low cost provider, then why am I the low cost provider? If people don't see me as that, and why I'm always having to be the cheapest person and trim my margins. and have struggles covering overhead costs.
Right. I mean, it really does you no good to look at rent or to incorporate that as part of your cost if you can't really do anything about it. I mean, what's the point? You've got to focus on other things that you can control, office supplies or insurance costs or personnel, those sorts of things that aren't necessarily fixed.
Yeah.
You've got to adjust the bottom line elsewhere.
Yeah, well, that's the truth, and even insurance and especially things like that, they're going up. You really need to understand. Okay, well, I can manage my overhead cost as much as I really can, but some things, you're right, I can't control, and I know these things are going up. So I need to sell and manage my actual physical transactions that are bringing cash into the business. I need to manage those better to be able to cover these costs. So I either need to raise my prices or I need to cut direct cost. I just need to increase my margins to improve on that.
Yeah, and it's not only kind of reacting to what you see today. It's, as you said, things are going up. You know things are going up. You need to plan for that. And a lot of companies don't even have a budget. And if you don't have a budget, you're really going to struggle in meeting your financial goals. If you don't know where you've been, it's going to be hard to get to where you want to be, because a lot of time history repeats itself, or at least you can see some patterns and see what works and what doesn't. If you're just shooting at the hip, then it's going to be tough when you have these cost increases. You need to kind of build those in and plan for them.
Yeah.
But is there any up and down to my business that I can anticipate? You need to be able to plan for that. So it's not just looking at today, would we do right, would we not do right? You have to anticipate. You have to build in these increases. You have to build in anticipated loss of business for whatever reason. You really need to have a cushion. And the financial reporting can give you some insight to that, but budgeting is very critical as well. And monitoring that budget. Are we meeting it or not? You've got to be proactive, and that's always make adjustments to stay ahead of the game, really.
Absolutely. Well, and that's why it's so important to be able to close your books on a consistent basis, or at least get a decent close where your gross margins and you're getting your most of your overhead costs included on a consistent basis. Because if you're only doing that once a year, or you're only doing that once a quarter, it's hard to look at fluctuations in the business. And let's face it, I mean, things are changing on a consistent basis nowadays.
The only thing consistent is change. That's right.
Exactly right.
Yeah, no, that's exactly right. A lot of business, it's easy not to close your books. It's easy not to produce financial statements. Right. It's easy not to do things, and it is to actually do them. But a lot of these small businesses that we go to, they don't have the capacity or the understanding to do that. And you go in there, it's like, you guys are a mess, and you don't have to be a mess. These are the simple things you need to do. Start implementing these monthly financial statements, get it closed in 2 weeks or whatever it is. And once they do that, and it can be a process to get there, granted, but once they do that, it's just so eye-opening for them. Now I understand my business. Now I understand my challenges, where I'm making money, where I'm not, and they can operate much more efficiently with that. Sometimes they just need to be shown the importance of it and how to do it, because, like I said, it's real easy not to do it. But it's counterproductive not doing it.
Yeah, I would agree with that. And continuing to discuss the importance of getting good, timely financials out. And I think one of the biggest problems that people run into is that they get so far behind. That cleanup process and the process to get there can take quite some time. I mean, you have several clients right now, and that process can go on for over a year, because in a lot of cases, you've got antiquated systems or software. You've got antiquated processes. You've got things that have to be caught up to a certain point because they've been done in, let's call it, a haphazard way for quite some time. Getting there is a fairly arduous process. And it can be a very expensive process as well to get it done right. And so I think this is where a lot of people, they lose faith in the process because they're not seeing instantaneous results.
Well, that's true. Yeah. No, there is some delayed gratification to that for sure. I go to some of these clients and they've had supposed professionals doing their books, CPAs or whatever, and you go in there and it's just an absolute mess. It's like, what have you been paying this person all these years for? Because your books are nowhere where they need to be. And it's hard to tell them that. They need to know it, but it's hard to tell them. It's like, this is why your business is not running right, because your books are not right. Yeah, can we clean it up? Sure. Is it going to take a while? Yes. But are you going to be much better 6 months or a year down the road? Most definitely, yes. And it's, like I said, it's a hard pill to swallow, but it's a necessary evil that you've got to get your books in order. Otherwise, you're going to perpetuate, and it could really cost you, in the long run.
Oh, well, it'll end up costing you more in the long run, because the more that you put it off, the more work that needs to be done in order to get it right. The real issue is that there's so many different interpretations on ways to do things. And this happens a lot with smaller companies. If I'm not having to get good gap compliant financial statements out on a consistent basis, then that's going to kind of fall away. Well, I don't need to spend money on this. It's just something that somebody told me that I had to do, and then it just kind of falls off. And you deal with the people that you work with at that level. You have a different interpretation on what marks a good financial statement for a manufacturing company,
Right.
and I have an interpretation, and we have two totally different. I could have public company experience. You could have nothing but private company experience. I could have a mix of both, and you could have a mix of both. I mean, or you could have come out and been in public accounting for most of your career, and so they're different interpretations. They're different points of view. They're different perceptions on what represents good reporting. And so what ends up happening is you go from one person to the next person. You go from all these different perceptions on what amounts to good reporting, and then next thing you know, it's like, all right, now I've got a mess on my hands. And sometimes it's not their fault. It's not necessarily your fault. It's just nobody really comes in and shows you the importance of this. It doesn't become important until your banker or your auditor or your tax person is breathing down your neck and saying, I need financial statements in 2 weeks in order to get this done.
Yeah, no, that's true. I mean, you've got other folks that you've got to report to at some level, whether you're public or private, or whether you've got a loan or not. You've got other people who are interested in what you're doing, and they want to see something that's meaningful, something that's timely. And you don't want, like you say, somebody coming up and say, hey, in a couple of weeks, I need to see where your guys are at, and you haven't booked anything for 6 months. I mean, that's just trouble. And again, you can't just go by managing your business by what you have in the bank account. Really tells you just very little.
Yeah.
And unfortunately, a lot of them do, because it's easy and I can pay my bills. That's all I care about. Well, maybe so, but you should care about a lot more than that.
Yeah. And I think it's a misconception on the level of sophistication that you need, and really what that sophistication costs. And the earlier that you get started, the better off you're going to be. And the more that you get started on a time frame that you can manage, the better off you're going to be.
Yeah. Yeah, for sure. And like you said, I mean, it's important to do it, but it can't be important just for the accountants. The business owners and all associated parties need to understand, what is the benefit of this? Why is it important? Why should I be concerned with it? Show me why I need it. Show me why it's important. And once you do that, then it makes a difference. It's not just, well, you need to hire 6 months to clean your books and you're not going to get anything out of it. They've got to see the value in it, obviously.
Yeah, absolutely.
And like you said, a lot of them aren't sophisticated to really understand what that means. And again, that could be another process to say, here's where you are, here's where you're going, and this is how we know, and this is how you're going to look in 6 months down the road. It's an educational process a lot of times.
Yeah.
On the value of that.
Yeah, and serving as the basis. I mean, good standard financial statements, good gap compliant accrual-based financial statements are the foundation for building an FP&A function. So that's the foundation for building your budgeting. That's the foundation for building your forecasting.
Yeah.
That's the foundation for tracking how your business is doing, predicted versus historical, and understanding exactly where you are. And I think that's really the thing that excites business owners, is being able to know that. It's just the process to get there. You're building a house. You don't build the roof first and then build everything else underneath. You've really got to build that very, very strong foundation. And that foundation is the processes for how data gets into whatever system you're using, and how that data gets manipulated to generate a good financial statement. And then everything else is based upon that good financial statement.
Yeah. And if you go into client and you're kind of going to reconstruct or construct, in some cases, financial statements. Okay, business owner, this is what I need. I need data from this period for XYZ. Okay, I'm not sure I have that. Let me try to find it. Sometimes it's a treasure hunt, even for them to find what you're looking for. They don't even know if they have it. They might have it. They might have filed it in somewhere else because they didn't even know what it was. So even getting all that information to be able to produce financials sometimes can take a little bit of time as well.
We know that all too well.
Yeah. And again, it's just a level of sophistication and education that manifests itself in different ways.
And there are other things for them to look at. I mean, obviously you want to create budgets. And nowadays with technology, you can create very, very sophisticated forecasts, much more so than what you used to be able to. And a lot of that can be automated. Getting a good financial statement. There are also some good indicators that you can look at between an income statement and a balance sheet that can tell you a lot about how your business is doing.
There's a lot of benchmarks and milestones. Receivables are good, but they've got to be current receivables. If somebody owes you something from 6 months ago, it's likely going to be uncollectible. If you've got most of your receivables under 30 days, you're probably doing okay, and you can kind of count that as cash you'll receive. You want your payables to be manageable. If you've got 30-day terms, you need to pay within those 30-day terms, because the more you lag that out, the less credit, so to speak, you're going to have from vendors, and that can really spiral downwards pretty quickly if you don't keep up with your bills. So everything is interrelated, and if you don't have enough money coming to pay your bills, then things can get bad pretty quickly.
Yeah, a lot of that boils down to managing things on a per transaction basis. So making sure that you're invoicing correctly on a timely basis, and make sure that you have a good process for receiving and entering in bills on a timely basis. Yeah, you're right. In times where interest rates are going up, or you may not necessarily be able to get traditional financing or expand traditional financing just because of the nature of the market and what the business is doing. Vendor credit is where it is. That's literally can run your business. So managing vendor credit terms is a whole new can of worms, but managing the credit terms that you extend your customers and clients, and versus the credit terms that you're getting from vendors and the amount of credit that you have from vendors makes a big difference. But if you don't have an accurate accounts receivable and accounts payable, that's very, very difficult to manage.
Right. And your point to billing is well taken. I mean, you don't get what you don't ask for, right? And customers aren't going to pay you if you don't bill them. Oftentimes that can be an issue too. Yeah, billing is kind of a pain, but if you're not going to bill, you may as well not be in business, because you've got to collect on the back end for all your efforts. And there's been a lot of customers who the billing and collections has been somewhat lax, which obviously negatively affects your cash flow and then throws you into another bad position. You've got to have a robust billing system where every 2 weeks or every month or whatever it is, you get those bills out and make sure you collect within terms. Billing is only part of it. You've got to make sure you receive it and credit it properly. And if they don't pay, you've got to have receivables team to follow up on it.
Yeah, absolutely. Yeah. No, absolutely. And any business owner, you almost need to be looking at it on a daily basis. You really need to understand what your AR and your AP is on a daily basis, and how that correlates. I mean, obviously, you want more cash and AR than you want AP and other debts.
Of course.
That means you're making money.
Right.
So, or you at least have money to cover things. So that's something that you need to be looking at consistently, and that's a huge indicator on whether or not your business is doing well. If you have more AP and debt than you have cash and receivables coming in, then you've got some issues. Not that short-term debt, not necessarily long-term debt, but that's a sign of poor financial health.
Yeah.
You can, even without a formal close process, you should still be able to track AR and AP.
And there's a lot of business owners who are proactive in monitoring their receivables, which they should. It's like, how come I've got $1 million in receivables from 3 months ago? You shouldn't have that, right? At least they're smart enough, so to speak, to know to look for that. But the other thing you want to look at is your work in process or unbilled work. I mean, why do you have so much that's unbilled? I mean, if you've done the work, you need to get the bills out. And that can be a real easy trap to fall into, is we'll do the billing later. And it just accumulates, hits your cash flow because you never bill for it, or you bill late for it. So these are all things that you've got to stay on top of to get the cash flow where you need it to be, so you can have accurate financial. I mean, the bank doesn't want to see huge receivables. The bank doesn't want to see huge work in process either, unbilled work, for financing or just general purposes. That's not good business.
Yeah, absolutely. And in a lot of cases, especially with smaller companies, you've got one person that does the billing, and you have a very manual process, and they have to go through and they have to do this and they have to do that. And in some cases, there are no checks or balances to that. So invoices may be wrong. It may take a week to get an invoice out. And those payment terms don't start ticking until that client or customer receives that invoice. And so that is, that's a big issue. And we've seen some people, it take them a month to get an invoice out. And then they have 30-day terms. So really, technically, you're on 60-day terms for anything services that are provided at the beginning of that month.
Right.
And if you've got labor that's involved with that, well, you're paying that labor once a week or every other week. Even if you're paying that labor once a month, you're still running negative terms out there. And then you've got 30-day terms from all your vendors. Well, you're killing yourself, because it's taking you a month. Because I have to invoice once a month because I only have one person to invoice. And so we just send them all out in a batch once a month, unless you have huge margins. But that can create some big situations for you.
Yeah, for sure. Yeah. Billing has gotten simpler in some respects. A lot of companies, you can send invoices electronically. You don't have to print and mail. So things have improved, but companies need to be able to take advantage of these technological improvements. Once all the work's in, press the buttons and send the invoice out. So that can get you cash in quicker, but it just has to be done. Somebody's got to do it. You just can't sit on it,
Yeah. Yeah.
regardless of what the system is.
Yeah, yeah, absolutely. You need to be able to look at those types of things, and it all boils down to having good, timely financial statements. One good metric is, days sales outstanding (DSO). So, from what is my metric from when I invoice to when I get, or when the point of sale to where I actually get paid. And a lot of people say, well, I have 15-day credit terms. Well, okay, really, but your DSO could be 45 days, depending on how you bill and how frequent you bill and when you're actually getting paid. And you have days payables outstanding too. How long is it taking me really to get invoices or get payments out to vendors? Because that's what they're tracking.
I think a lot of times the employees may not think about it, and the business owners may not think about it, but looking at everything on a holistic basis. You've got work that you've done, you've got to bill and collect for, you've got things that you've purchased that you've got to pay for, and all that's got to dance together. You can't look at billing and invoicing as one bucket and payables as another, and all these things, they all fit together. And if one of them is out of sync, then it's going to throw your whole system out of sync. So you've got to focus on everything together to make sure that flow and that cycle stays where it needs to be.
Yeah, and it all ties together on a financial statement. Good financial statements on a good frequency are the foundation to getting that done. If you have things set up properly, also, now you will get real-time information. If you got a good process for invoicing and you have a good processes for tracking direct expense, you can get almost real-time information on gross margins, and that's big for running your company. You can make adjustments on a weekly basis when it comes to that. And that if you don't have that good structure for that good financial statement, then it's going to be very difficult to get that information.
Right. And the thing that you have to somewhat be aware of is you can get as much information as you want, or sometimes more than you want, sometimes more than you need. You want to pull information that's really relevant and that's meaningful. Because a lot of these systems, maybe not so much in smaller companies, unless they have a really robust system, you could have a report list that's got 100 different reports. Do I need all that? Of course not. Well, you've got to pick what of these reports are really meaningful to me. What do I really need to know to operate this business and to be profitable? The other 98 reports I may not need. But you've got to pick out what's important to you and be consistent and run those reports and get the information you need from that. It's there. You just don't want to overload yourself, because then you're not doing yourself any good.
Yeah.
If you just got so much to look at. So everything is not critical, and you need to filter out what is and what isn't and go with that. And you don't need a whole lot of metrics, really, especially in a small business, to really know what's making you money and what's not, where you need to shore up things.
Yeah.
But you've got to have something to manage with.
Yeah, absolutely. And it's unique to you. And that's where a lot of the business owners' intuition comes in, and just how they choose to run their business. I mean, for some businesses, revenue is the most important thing. Okay, and that's fine. And if you're on a point of sale process, or you're a point of sale business and you're selling a lot of things and prices are fairly consistent, then revenue is important because your expenses you're fairly consistent. And there are businesses that are like that, or your margins are so huge you don't necessarily need to track them on a consistent basis.
Right,
but
sure.
If you're in a more of a commoditized business, well then, margins become important, because you start selling business, and you're selling business at such a slim margin that you're really just turning dollars. So gross margins are more important. Or it could be, items sold. It could, there are all kinds of different things. I mean, I will say, me as managing partner at Emergent, I track different metrics than our competition does, just simply because our business is different in nature. And there are different things that are important to us. We manage our transactions differently than other people do.
Right. Every client's a little bit different, as you noted. What's important to client A might be totally different for client B. And you have to understand what their business is to say that you really need to know this. You may not have looked at it in the last 5 years, but you need to look at it every day now. Or what you've been looking at every day, it doesn't mean anything. Don't save your time. Don't look at that. So sometimes a little guidance there to show them what's critical and what isn't. Is often helpful too.
Yeah. And I think in a lot of cases, we have to ask ourselves a question, why? Why is this metric important to you? Why is this thing important to you above other things? Because, sometimes you may be right. That may be the most important thing in your business, or it's the thing that makes you sleep at night. It may not be the most critical metric to how the business runs, but it's a metric that helps you sleep at night.
Yeah.
So that's okay. We can include that in there. But the question is like, why? Why is this important to you? And how does this really align with what you're trying to do with the business? And I think this is where there's a big disconnect with financials, is a lot of people see financials just something they have to generate for a bank or a tax CPA. But really, it's all encompassing with the business. It's something that everything flows in and out of. And if you're really going to effectively manage your business, you have got to get to the point where you start getting good, consistent financial statements.
It kind of what you're alluding to there is the financial statement it's not a historical recap of what's happened. It is that, but only in part. It's an indication of the health of your business, of opportunities and threats to your business. If you look at it in a different way, if you just can't look at numbers, okay, well, this is up, this is down. Well, why is this up? Why is this down? How is that going to impact me? You have to dig through the numbers to really understand what you're looking at and the implication of that, not just the top line number, if it's good, bad, or indifferent. So it's not just a snapshot of a day or a month in history. It's some insight into the operation of your business, and you have to understand what it's telling you so you can make adjustments as necessary. And you're going to have to make adjustments pretty consistently in a lot of businesses just to stay above water. And the financial statements will enable you to do that if you use them properly.
Well, see, and I think that's the importance of why that strategic piece needs to be involved, because so many smaller companies, they've got someone that's at a manager level and they will generate a financial statement. And okay, that financial statement looks good, okay, but really having that higher level insight, that understanding on how all of this ties together to really explain, okay, well, this number changed month to month. Here's some insights into why, or let's talk about some insights into why. Let's start the discussion so you can understand, is this something that's really going to be detrimental to my business, or is this a one-time situation based upon market fluctuations or whatever else is going on? Or is this just the general cyclical nature of the business? But let me understand and define that. A lot of businesses, especially that are tied to commodity prices, they go up and then they go down. They go up and then they go down. And a lot of times they get to the point where the ups just cover the down. And you're just rolling through this vicious cycle. And you're not really growing. I mean, you want to go through the ups and downs, but you also want to have a growth curve there. Right. And if you can't predict what's necessary to cover the downs, then it's very, very hard for you. We've been using this term for years, but it's like running a Ponzi scheme on yourself. You're robbing Peter to pay Paul consistently. And then just all you're doing is just keeping up, basically, and you're not really growing the business. Because you don't have that information and you're not able to get those.
No, that's right. You want to have a nest egg, right? Because things are going to happen unexpectedly. You can go to sleep tonight and tomorrow something major could happen that you can't anticipate. And you want to try to position yourself to where there's some of these unexpected things because they're going to happen. I mean, the COVID obviously was a big thing. Nobody could have predicted that. A lot of companies, the smaller companies, even in my neighborhood, they said there's no way they're going to survive. They're still around today. Some of the larger companies that you would think are solid are not here anymore. Did it have to do with planning? Maybe, maybe not. Who knows? But you just don't want to be able to pay your bills a day at a time. You need to predict and prepare to weather some of these ups and downs, like you mentioned, because you never know when they're going to happen. You only know that they will happen at some point. And again, the financial statements will give you that insight and to be able to position yourself to weather these storms a bit better.
Yeah, absolutely. And so again, that's why it's important to start now. You covered a lot of points, and it can be a lot to digest for people. But what would you say from your point of view, the biggest takeaway that you want businesses to have from this conversation as it relates to getting good financial reporting in place?
If you want to run a good business, you have to have good financial statements. Get staff that you can trust, or get some help that you can trust to build those statements if you don't have them already, or if you have them and don't understand. Let somebody help you understand them. Find out where the pitfalls are in your business and where the opportunities are. And that way you're able to move forward in things that are more meaningful for your business. But you've got to have the data and you have to know how to interpret it, what it means. And once you do that, you're going to be in a much better position in the future to continue a successful business.
Yeah, I would 100% agree with that. And I would take that a step further and say that my biggest thing that I would want people to take away from this is that start now. Don't wait until there's a problem to start now, because it can be a long process and you will become disillusioned with the process. We see it all the time with clients, and we have to keep them going and keep them going. So depending on how long it's been since you've had good financials, and maybe it's never, it's a process that can take multiple months and in some cases multiple years. I would say that's a big takeaway. And I think the other takeaway is that understand that this role is evolving. The role of generating financial statements in your business is evolving because let's face it, business is a lot more complicated nowadays than it used to be. And it takes multiple skill sets nowadays. You can't just have one person sit in that seat and they're going to solve all of your problems. No. It used to be that way, but it's not. You need that strategic aspect. You need that hands-on, high-level management of what goes where and understanding all of the ins and outs of accounting practices. And then you need that transactional aspect. And then you need a totally different skill set when it comes to planning and budgeting and forecasting. Things have become complicated to the point where it's multiple skill sets. So you need to look at multifaceted solutions in order to really get to this point. It's not just, okay, well, I hire a bookkeeper and a bookkeeper comes in and a bookkeeper fixes all my problems. Yeah, they're going to get you to a certain point, but they're not going to get you all the way. And that's the age-old mentality. I know that's why you giggled about it, because that's the age-old mentality that these businesses have.
For sure. Yeah. Business environment has changed and will continue to evolve. Part of it's technology, and just part of it is the way the market is. Things aren't going to be tomorrow what they are today, and you want to be, at least on top of it, if not ahead, as much as you can be.
And then technology is a huge part of it. And there are no more one size fits all type solutions for these types of things. Really, the business owners, business leaders, they really need to be dynamic in how they look at this. And just understand that there's a huge benefit to it. Are you going to sink or swim because of it? Maybe not, depending on your situation. But it brings a huge bonus to your business just to be able to generate good financial statements consistently.
Yeah, definitely.
So, well, Steve, thank you for
enjoyed it.
Thank you for the conversation, and to all of our listeners, thank you for joining us at the Clarity Curve. You can catch us at our website at www.emergent-partners.com. You can also find us on LinkedIn, and you can find us on YouTube, and you can also find us anywhere that you can download podcasts. So thank you very much for joining, and look forward to seeing you next time on the Clarity Curve.